Welcome to Investors Guide. I am so glad you tuned in this week. It's going to be a fantastic show. What a stock market we are having. Our mutual funds turning around and giving us fantastic returns right under our noses from not having done anything. What we're going to do this week is we're going to take a look at how you should approach this stock market, how much more money is there to be made, and how can you put yourself in a position to make all of that money. Grab a pen and paper, write down our email ID, which is at the bottom of your screen right now. Over the next half hour, we'll first start by telling you whether it's time to get back into equity and how you should do it. In our product review, we look at the HDFC Top 200 Fund, and we'll make a list of all of the special offers available on home loans right now that you can use if you're buying a home. All right, let me bring in Narendra Kumar, our in-house expert. Narendra, thank you so much for joining us.
Thank you.
Of course, we have to address the big changes that have happened over the last 2 weeks in this country. We have a brand new government at the center. There's optimism definitely in the Lal Street if we see how the market has done over the last 2 weeks. For all of our viewers right now who are wondering, what does this mean for my portfolio? What do I do right now? Narendra, tell us what we can expect from this market that has run up so drastically. What can we expect from this market over the next 6 months or so?
There is every reason for investors to feel very happy about it because, if you look at in this month itself, the average fund prices are up about 9 to 10%. And so that is one reason to be very happy about it. Some of the prominent funds which we have been referring, they are up much more substantially. That part, I think, on a 5-year basis, it is, if there is every reason why one should be very optimistic because we have seen the kind of, we have seen economic deceleration, we have seen inaction, we have seen inertia. And now the business confidence or investor confidence itself has a potential to drive up the market. It is just not worth over-analyzing anything, but be into equity, be into high-quality companies, be into high-quality funds, be methodical about it. Don't get greedy. Don't try and get a market exposure, substantial exposure overnight. Be methodical about it and feel happy.
Narendra, I have a question for you on behalf of those of our viewers who panicked over the last 1 or 2 years, pulled their money out of equity, put it in fixed deposits and said, I'm never investing in the stock market again. Now they're going to turn around and wonder if they've missed the bus, if there's a way to get back into the stock market. Is this the way to do it now? Should we now start investing in equity funds? What is your advice for someone who wants to either get back into equity or wants to start investing fresh in the stock market at this point? What sort of funds should they be using and how should they get started?
First question, that have they missed the bus? No. I think we might be getting into something radically different on a long-term basis, and that could be very unusual. It will be very important for those people with belief in equity and India's long-term potential to come in methodically. If you don't have that, it will not be worthwhile because markets will be volatile. Markets will go up substantially, but it will not go up substantially in a very nice, smooth upward going line. So it'll be fairly erratic too, and it'll be with a lot of short-term disappointments. So those investors will lose their patience once again. Have your method, stick to a plan. The way to go about it, if you have never invested in equity, I would say consider a balanced fund. If you are getting into equity for the first time and gradually, and you understand the ups and downs, don't get into a mid and small cap fund or don't get into a large cap fund. Get into a fund which has proven credentials and a diversified fund, a multi-cap fund, and stick to a plan.
For those of our viewers who are watching right now who've invested in funds like natural resources, who've invested in power sector funds, infrastructure funds, banking funds, PSU banking funds, all of these funds have shown us a sharp turnaround over the last few weeks alone. Now, what should they do? Should they be now pulling their money out, moving it into diversified equity like you've always told us to do? Do you think there's more of a run-up to be hoped for? Or should they just take this as a good opportunity?
All those investors, they face the psychological barrier of, trying to recover their losses. Despite this huge run-up, I don't think many of those investors who invested in Reliance Diversified Power or natural resources or this or that, which was flavor of the day at some point, and after that, there was a debacle. Likewise, not very long back, 2 months back, we were getting questioned that which pharma fund to buy or which FMCG fund to buy, or they were on the top of the pack. they are struggling. They have not been able to participate in this whole rally as the way the market has gone up. So I would say that is the case for diversification. That is the reason why you should be into something where you don't which will save you from all the anxiety. Diversify and keep away from these things. Even give up on this idea that you have to recover the 100 rupee which you invested in these funds.
So remember, greed and fear are the two emotions you need to worry about most if you're investing in the stock market. The longer time you give your investments, the better it is. If you have any questions about portfolios or about the funds you're holding right now, write to us. Email ID is at the bottom of your screen. Let's move on to one of our viewers who's written in. Amit Das has written into our portfolio segment. He's 35 years old. He tells us he and his wife have a combined portfolio, and that's such an excellent idea. They also have a 1-year-old daughter. They'd like to plan for her future. With an annual income of 21 lakh rupees, their medical expenses are taken care of by an employer. Amit has a term cover of 1 crore rupees. His wife doesn't have a term cover, and that's reason to worry. Now, they have 5 lakh rupees set aside for emergencies. They contribute 10,000 rupees every month to a PF account and 1.25 lakh rupees to their PPF account. I'm not really sure if they need both of those. Now, they've got some goals that they've listed out: 30 lakh rupees in 17 years, another 30 lakh rupees in 27 for their daughter's future, 3 crore rupees for their own retirement. First of all, Narendra, should they both have life insurance policies? Because in my opinion, Mrs. Das should have a policy as well. Also, are they putting too much money right now in PF and PPF, and have they underestimated their goals?
Yeah, my sense is that they have underestimated their goals. Also, they are very conservative, and the result of that conservatism is also translating into this LIC policy, which is not needed. Of course, Mrs. Das should have that term cover. She is an earning member. And the idea of a term cover is that if she's not around, the income is completely substituted by the policy proceeds. So that should be a priority. And they should seriously consider phasing out the LIC policies, as well as the discretionary PPF contribution, because it looks there is an air around PPF that it is safe and it generates the fixed income and provides guaranteed return. That apart, PPF is unlikely to beat inflation over such long period. The worth of 3 crore at their retirement may not be the same 3 crore as we refer to it today. So they need to be careful about that. PPF can be stopped if not withdrawn. LIC policy should be withdrawn.
Well, let's take a look at his mutual fund investments, Narendra. They have the IDFC Premier Equity, DSP BlackRock Top 100, SBI Emerging Business, and iProve Focus Blue Chip Fund. These are all excellent funds, and they've obviously been recommended by you at some point during the show. Now, he has another question, apart from the fact that are these the funds that suit him. He says the expense ratio is very high on these funds. He wants to know, will it be more efficient if he were to switch to the direct option in these funds? And what sort of a tax implication will that have, Narendra? Because if he switches, that will effectively mean pulling out the money from one fund and putting it in another. That will involve some sort of charges, won't it?
Yes, it will, but he can plan it efficiently. One is that exit load will be levied if his investments are less than 1 year old. Only that part of the investment which is less than 1 year old. So maybe he should, retain the money in these funds, and incremental money can start moving into the direct plan. And as and when these investments get more than 1 year old, then that money can move into the direct plan. He can redeem and put that money into direct plan without any tax implication. Direct plans will be 1% cheaper, and it will be quite meaningful given his time frame.
Very quickly, what's your view on his fund selection? Can he continue investing in those funds?
He has chosen good funds, but these funds are not necessarily the appropriate funds for his goals, because I generally dislike funds with narrow objective, and all his funds are not narrow in that sense, but 2 of his funds are large caps and 2 of his funds are mid caps. Of course, the IDFC Premier Equity is not a mid cap fund by design, but it happens to be a mid cap for a while. But emerging business generally is also has been a mid cap fund. So my suggestion will be, why not track our aggressive growth portfolio without the fixed income allocation, because your fixed income allocation is taken care of with your emergency fund as well as your EPF contribution. So without that component, if you replicate our aggressive portfolio, that will be a more desirable thing. And if you are replicating our aggressive portfolio, two of these four funds can be retained, which is IDFC, Premier Equity, and SBI Emerging Business.
All right, so that's the advice you're getting right now. Get back in touch with us if you need anything else. Let's quickly move on to the next one. Gopalan has written in, Narendra, yes, an interesting question for you. He said a couple of weeks ago, you advised one of our viewers to sell ICICI Prudential Focus Blue Chip, as you did just now, and to hold on to HDFC Equity and HDFC Top 200. He says now, on value research, the rating for Focus Blue Chip is better than the other two funds. Please clarify why you did this. Now, if I remember correctly, it was a similar question where a viewer had a very long-term horizon, and you advised him that ICICI Prudential Focus Blue Chip is too focused for that long-term horizon. But for the benefit of Gopalan Srinivasan, could you take him through that advice of yours one more time?
Yeah, sorry for sounding like a politician that, that answer was in a context, but it was in a context. It was in the context of an investor's situation. And likewise, in the earlier question too, I would say that when you are investing for the long run, ICICI Focus Blue Chip is a great large cap fund. It has had a very impressive run so far, relatively new fund, and has been an extraordinary fund. For example, my understanding is that large caps had a great run, and now something else is going up in the market. But ICICI Prudential Focus Blue Chip is by its design, by its definition, it will be wrong for it to be moving into anything but large caps. So it will drag. It will not be performing at a time when large caps may not do well, or may just do moderately well, and the other parts of the market doing much better. So that is why one should be in funds which has greater flexibility.
All right, we're going to take a very quick break now, but when we come back on the other side, we'll review the HDFC Top 200 fund in response to all of the questions we've received about this fund over the last few weeks, so don't go anywhere. Welcome back. You're watching Investors Guide and ET Now. Thank you so much for staying with us. Narendra Kumar is with us as well, and we're talking about big funds that have recovered in reaction to the massive turnaround we've seen in our stock market. We have a question from a viewer called Nirmala Pillai, which is very similar to a lot of other questions we've gotten over the week. She invested in the HDFC Top 200 fund based on advice she heard on this show. Now, she says it was a strong performing fund. Suddenly, it went down from 5 stars to 1 star. She wants to know what to do with this fund right now. She also wants to know, since we advised viewers to invest in this fund, what do we advise them to do right now? Now, Nirmala probably doesn't know that the fund has recovered really, really sharply in the last couple of months. In fact, I'm going to bring in Avan, my colleague, who will give you an update on how the fund has performed. Avan.
Thanks, Faye. Well, the HDFC Top 200 is one of India's largest and most popular mutual funds. The fund was launched in 1996 and has since then consistently rewarded its investors. Except for the downturn of 2008 and 2011, the fund has consistently beaten the category average in every year of its 18-year history. The last year saw the fund go through a very difficult phase when, like the rest of the equity funds from HDFC, this fund's performance slipped when it gave a return of only 4%. But the fund manager Prashant Jain stuck to his guns and continued to hold on to his financial stocks like SBI, which remains his top pick. 2014 has been a completely different story. The fund has recovered smartly with a return of 24%, rewarding all the investors who stuck with it. The fund manager is very bullish on public sector banks, which he believes will be the long-term beneficiaries of India's growth story. Let's take a look at some numbers. If you invested 1,000 rupees in this fund when it launched, you would have 29,344 rupees today. So should you stay invested or pull your money out? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for that update. Narendra, this is the moment, of course, that you have been telling us about for the last year or so. When we were looking at HDFC Top 200, we were worried that it was not performing. You said continue to hold it for 2 more quarters and then we'll see how it's doing. If we look at the performance right now, are you relieved that your prophecy actually came true?
Yes, I'm quite relieved. I'm actually also relieved from the fact that, this is a fund which had such a compelling long-term history. and it struggled for a while, and because it had, and this fund was so popular, there are so many investors who have opened their SIP account, or maybe this is the only fund where they invest. And the sustained underperformance while the fund manager took a bet on a certain segment. And last year, July, the fund definitely went wrong with its estimate. And, it was the external factors or whatever happened. The fund did not get nervous with, sustained or relative underperformance compared to most other funds in its category. The fund's complexion has also changed. It has a far higher large cap tilt. Today, if we see nearly 70-80% into large size companies. Also, it is more concentrated on the top, 51% in top 10 stocks. But more importantly, here is a fund which has regained most of the lost ground. All its conviction has worked to, things have worked out in its portfolio the way the fund manager planned it. And this may not be the end of it. I think there might be, we have seen a very modest recovery on the hypothesis that the fund manager had. And, of course, now with this event that a government with complete majority and the positioning of the portfolio, I think, this is a fund which has proven its mettle, proven its credentials once again.
Well, Narendra, here's the big question. Now, for those of our viewers who are holding on to the fund, you obviously say continue to hold on. Would you recommend it to anybody to buy right now, the HDFC Top 200 fund?
Absolutely. I would say that it is worth buying. I would like to mention here that, a lot of investors were also very upset or disappointed by the decline in our rating. And the decline in our rating compared to a qualitative assessment, my views are very different from the rating. Rating is a quantitative model, and it follows a very methodical set pattern based on a mathematics, which is if the fund is doing, falls more often than other funds of the same category, and is unable to rise as much as other funds in the same category on a sustained basis, on a month-on-month basis, then it slips on the rating. I would say that yes, it slipped on our ratings, but we never degraded it in our own mind. We were coming to a point, it was really causing anxiety. We were concerned, we were talking to the fund managers more often to understand what is driving his thinking. And of course, it is the last 1.5 to 2 years, we see that many other promising funds have emerged compared to this, and this fund certainly went wrong with one or two of its assumptions, which did not work out to its plan.
All right, Narendra, finally, give us your star rating now of the HDFC Top 200, keeping in mind its recovery over the last 2 months.
I would assign it a 4-star, and exactly as the risk-adjusted rating places it.
All right, Narendra, many thanks for joining us on the show on Investors Guide. There we were talking about HDFC Top 200. Now remember, over the coming weeks, we're going to review all of these big funds that have begun to recover. But before we go into break, for those of you who are looking to buy a home or maybe take a home loan, this is a really useful story. This is a list of all of the offers that are available from various banks right now on home loans that you might want to take advantage of. Take a look.
The competition among banks will leave you reason to cheer because the market is flooded with offers on home loans. To begin with, ICICI Bank dropped its interest rates to 10.15% from 10.25% for a loan up to 75 lakh rupees. And it is the lowest competitive rate in the private sector. The scheme is available only to salaried consumers. If you are a woman and you are the first applicant or the primary owner to the property, you can avail an interest rate up to 10.10% from ICICI Bank in the private sector and SBI Bank from the public sector. Axis Bank has a scheme called Asha Home Loan. Under this scheme, families buying a home for the first time can pool in their incomes for eligibility instead of applying based on one's individual income. The scheme is available to families with a monthly income of 8 to 10,000 and above, and homes starting at 325 square feet. The loan tenure is for 30 years, thus reducing the burden of EMI. Axis Bank also offers EMI Ki Happy Ending. Here the last 12 months of your EMIs are waived off by the bank on loans of a 20-year tenure, provided you pay the EMIs at least until the 15th year. The offer is available till the end of this month. And SBI has a scheme for the youth between the age group of 21 and 45 years called the SBI Yuva Home Loan. In this scheme, you will be given a loan that is 20% higher than your eligibility. provided you have a monthly salary of 30,000 or more. You only begin to pay the principal amount after 3 years, therefore reducing the EMI burden temporarily. Though in the long run, you may end up shelling out more. But you could benefit in the short term if you're burdened with other financial responsibilities.
All right, so remember, if you have any questions about anything you heard on that story or about home loans, you can write to us. Email ID is on your screen. Coming up after the break, we're going to sit down again and we're going to talk about how you should allocate your assets and how you should deal with insurance policies. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. We brought in Gajendra Kothari to answer your questions on insurance this week. Gajendra, welcome to the show.
Thank you.
Amit has written in. That's our first question. 35 years old. He wants to buy a family floater plan. He wants to know how to choose a family floater right now and which one would you recommend?
You can actually go for a health insurance floater plan for a family. So for your age, it would cost roughly around 5,300 rupees. And there are many options available to you. You can choose from Apollo Munich. They have a very good plan called Apollo Munich Optima Restore Plan. In that plan, if you buy a 3 lakh rupees worth cover this year, and if you don't claim any amount this year, next year the amount becomes 4.5 lakhs, which is 1.5 times. And even if you don't claim next year, it becomes 6 lakhs. And there are no deductibles, there are no co-payments there. So that's a very good policy you can look. They also have a policy called Easy Health policy, which is also a very decent policy. There are other policies in the market. You have Max Bupa policy for family, and then you have ICICI Lombard. So you can consider buying any of these policies. And again, health insurance policies, like I would say, the more options, the more facilities you want, the higher the premium goes. So if you are a budget investor looking for a budget kind of a policies, then you can go with the policy which I mentioned. If you want higher premium policies wherein you want a single room and other thing, then the Max Bupa Family First is a good plan wherein you can include all your members, and you can go for a gold plan, but that will be slightly expensive.
Our next question comes in from Ganesh Mallya, who's 47 years old. He tells us he invested 48 lakh rupees in the HDFC Supreme Life Insurance Plan. The value today is 32 lakh rupees. He wants to know what he should do now. Should he exit the plan and cut his losses, or is there hope right now to hold on?
This policy again has a very high policy administration charge. So because you already paid for 4 years premium, I would recommend you to pay for 1 more year, because after 5 years the surrender charges are nil, and then if you withdraw, you'll not be paying any charges. So I would request you to stick around for 1 more year and then consider signing this policy.
All right, last question on the show. Rishi Gupta has written in, 41 years old. He wants to buy a term cover. It's always so nice to hear someone say that. He wants to choose between the Aviva iLife, Max Life Online Term Plan, HDFC Click to Protect, and Tata AIA Life iRaksha. He wants to know how he should choose between these plans. Gajendra, could you give him a checklist that he could use?
Hello Rishi. Again, I would like to congratulate you for taking this great decision to buy a term plan. This is the most smart thing to do. You already have selected 5 term plans. So basically, I just want to clarify that all term plans are good from any companies. There's not much to consider. It's just that you have to see what are the benefits in each policy vis-a-vis the premium you are paying. So you have to compare the benefits and the cost. Okay, so some companies may offer for a longer time horizon. Some companies may offer accidental death benefit rider. Some may not offer that. So you have to choose your plan accordingly. Having said that, all companies are good because they're all registered with IRDA, so you have nothing to worry as such. You can decide which company you want to go for, sometimes based on your brand preference. So sometimes people like public sector companies, they think they have more trust there. So you may be paying extra premium for that, but then at least you have a peace of mind. So what I would suggest is that first compare the benefits vis-a-vis the cost which you are paying, and then you can choose your brand preference and then take your call accordingly.
Gajendra, thank you so much for answering all of our questions on Investors Guide this week. Remember,
thank you.
Any question you have about anything at all to do with your money, email ID is on your screen. You can reach me personally on Twitter as well. Tune in next week to catch Investors Guide. Thanks for watching.